Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of October 13th, 2024. And in this week's episode, it's just myself, Sprocket 888, and I decided that this week I'm going to take you on a ride along. It's time for me to go out for some more plays in my portfolio. And one of the ways that I really think is the best way that I learn is kind of see what other people are doing while they verbalize their thinking process as they go through it. So in this week, Sprocket 888, myself, is going to take you on how I go hunting for an open trade because I'm looking to put some trades on with some capital next week, and I'm going to take you through my thought process on how I go out for those. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders. Love to hear what type of content you want to hear about, and love to know what you're out there trading. Also, you can find a link to thetagang.com/Sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And what I wanted to do this week is really take you along through a live session of myself and think out loud, if you would, on what I am looking for, what trades, how do I go find where I want to deploy my capital. So I have some free capital coming up where I want to allocate and deploy it next week. And I really want to see, okay, what am I going to target? Now, this is not exactly the trades that I'm going to take, but it's a high probability that I'm going to take these. And really don't take this as I'm going to do exactly what you do and I will be met with great success. No, that's not the point of this video. The point of this video is to let you into my thinking and my line and thought process in hopes that that will help you understand what I'm considering, what I'm going through, and you can find out what parts of that are applicable to you. So don't really dwell too much on the types of plays that I'm picking out, like the actual stock tickers, but more the concepts that are underlying, because that is the stuff that if you understand and it jives with you, right? That's where you will mold it and make it your own and bring it up in yourself. And that's really where the true success will be. If you simply copy somebody, whether it's me, some other trader, you might be met with success, but you're always going to be trailing success, right? Because your stuff will follow someone else's who follows something, another derivative of them. Or you're just becoming further and further back from what's actually happening in the market. Plus, you won't really understand what's going on. So if something pivots, something changes, and that person that you're copying or that thing that you're copying doesn't, make it transparent, or, you don't see in time what their thought process is on how they pivot, it's just not going to end well for you. So don't take this as a video to copy. Take this as a video to observe and understand. And I'm going to do my best to kind of walk through all of the thought process of when it comes to deploying fresh capital from my perspective on what I'm considering and how I choose what I'm going to put my money in for the trade. All right, so the first thing that I'm going to do, think of this like your shopping list, right? Maybe every week, every couple weeks, once a month, whatever it is, right? You're going to go to the grocery store and you're going to say, gee, my shelves are a little bit empty. What do I need? I might need some milk. My eggs are kind of low. I'd really like to cook some steak this week, or, I've got some chicken on the menu, but I don't have that. So you really think, what do I need? What am I after? What's on my shopping list? And when I think about this in terms of deploying capital, I'm not thinking what is the name that I want to play? What is the industry that I want to play? Because that's not really how I stock my shelves, if you would. So what it comes down to for me is I am a premium selling individual. So my bread and butter is basically selling premium on options. And what premium is, you can go back to some of my options videos to drill into that. You can Google about it. But really what I'm doing is I'm looking for theta. And theta is the time decay. So I'm selling options in hopes of generating time decay and profiting from that premium. And so most of my trades really boil down to two things. I either want short-term trades, and in my case, a short-term trade is about a week's trade. So these are typically earnings trades. So are there any interesting companies that are coming up with earnings soon? And if so, is that what I want to engage in? So typically on an earnings trade, I will put a trade on for an option that expires that week. So those trades never extend longer than a week's time. And I only like to have so many of those shorter term trades because, I like a little bit longer term premium burn. And that's the other type of play, is what I would consider a regular term play, which in my case is about a month. So I like to sell premium on options that are about a 35 to 45 days to expiration. So that really puts me in either the current month's expiration or the next month's expiration. And that is kind of the basis or the foundation. Now, once I have enough of those trades out there, I'll go ahead and sprinkle in some shorter term trades because they're kind of fun. Plus, you get these nice pops potentially, depending on where the volatility is. And so that's really the first question that I'm after is, do I want to put short term trades on, or do I want to put long term trades on? At this particular juncture, I'm, a little bit more on the shorter term trade from what's currently in my portfolio, although I really could open either one. So I'll probably show you a screener for each of these things and talk you through that, and then we'll kind of drill into one of those. Now, the last thing I'm going to look at is really just to kind of get a gauge for whether or not I want more or less delta. Now, I don't want to drill too much into this because it could be a little confusing for a newer user. But generally, I try to keep what's called delta neutrality in my portfolio. So my holistic portfolio, I would prefer that it does not gain a lot if the market goes up, and it does not lose a lot when the market goes down. And you might think, well, what the heck do you have a portfolio for? And so in the nature of premium selling, like I said, I'm going after that time decay. And so my portfolio prefers to be delta neutral. What that means is it doesn't matter if the stock market goes up, it doesn't matter if the stock market goes down, your portfolio value roughly stays the same or similar. And what I'm profiting off of is time passing by. So I like to keep that daily theta decay around a certain number. And I don't like the skew that it comes with, positive delta or negative delta. So you can Google delta neutrality. You can look on past videos and find some of that. But that's really where I like to keep it. And so I gauge, where is my current portfolio at? Do I need more delta? Do I need less delta? Am I kind of in the middle and just deploy neutral delta? So I'll touch on that a little bit, but generally I will try to enter trades that are delta neutral because I usually keep my portfolio pretty delta neutral. So I'm not usually adding trades to increase or decrease my delta. All right, so what are we going to look at? And this is what I'm going to call my core items, and I put them really in the order of importance. And I'll kind of talk about these, and you'll see as I go into the screener, I'll talk about where these things sit. And this is my checklist, if you would. If number one fails, I'm done. You bail out. If number two fails, I'm done. You bail out. Number three is kind of optional, but generally, if you get in line with number three, then it's definitely a proceed forward. So if you hit 1, 2, 3, green is go. Let's put that on the trade target. I still might enter a trade without a number three, but there are some caveats to that. So 1 and 2 are definitely, if those are no good, I bail, and that's not interesting. And number 4 is really just about, okay, this is the trade that you want to do. How big of a trade do you place? That's the position sizing portion. So number 1, liquidity. Liquidity. I can't say it enough. Do not enter any trade that is not liquid. Basically, liquidity is the ability to buy and sell very fast, very fluid. Whatever the underlying is, whatever the instrument is, if you don't have liquidity, it will be hard to unload it. It will be hard to enter it, and you're going to get what's called slippage. Okay, if you don't have enough buyers and sellers, the fair pricing of the market does not work as well. So the more liquidity, the more fair price the market will determine automatically. What do I mean by that? Well, if you don't have a lot of buyers and sellers, you're going to get very wide spreads. And so you might be tempted to go up to a particular number. That's called slippage. What you really, really want for liquidity is you want your price to be very, very tight. So you want the buyers and the sellers to basically be offering at almost the same price. That really means that they're really close to each other, and you're probably going to get filled somewhere in the middle. If you don't have a lot of buyers and sellers, that number that the buyers want to buy at and the sellers want to sell at will be very far apart. And who knows where you're going to end up in between them. So the two measures that I really look to gauge liquidity are twofold. The first one is what I call more of the rough screening number, and that's the volume. So generally speaking, the more volume instrument has, the more liquid that instrument is. Not always, but generally speaking. And so that's kind of my rough cut measure. And then my fine tune thing is to observe what's known as the bid ask spread. This is what I just kind of talked about, where what are the buyers offering to buy at and where are the sellers offering to sell at. If that number is very close to each other, that is the spread. The distance between the buyers and the sellers is known as the spread. And so if your bid-ask spread is very tight, it means the buyers and sellers are really close to each other, which is an excellent sign of very good liquidity. The farther apart the buyers and sellers get, the less liquidity there is, and the more slippage there's going to be in your fill price. And so number one is always trade things with high liquidity. All right. Number two, number one really, in my opinion, goes for whatever your trading style is. It doesn't matter if you're trying to swing trade, if you're trying to sell options, buy options, whatever. Number one is always there. Number two is specific to my particular type of strategy of selling premium. Okay. So this is what I'm going to look at. I'm going to look at elevated volatility. So think of premium as basically insurance. And the more risky the environment, or the more volatile the stock price is, the higher the premium is for that insurance. So I always equate it to storms and hurricane insurance and stuff like that. So the more prone your area is to violent storms, a lot of turbulence like Florida, the insurance is much higher than areas of northern Maine when it comes to violent storms that might wreak property damage. And so volatility is basically the movement of price. So the wider the swings of price, the higher the volatility. The higher the volatility, the higher the premium. And so what I like to look for is underlyings that have elevated periods of volatility historically. And so I look back at the past years of volatility and I look at it as a percentage. So it goes from 0 to 100. And where is the current volatility relative to the past volatility of that underlying? It's not relative to the market. It's not relative to another underlying. It's relative to itself. And so if you got something that, historically has been in the 20 to 40% volatility range, and now all of a sudden we're at 60, 75% volatility, that it will be a very elevated state of volatility. And so that's sometimes known as IV percentile, historical volatility, something along those lines is what your brokerage is going to call it. That is my second most important screening mechanism, because I am playing for that volatility contraction. So the higher the volatility, the higher the probability that it's going to decline. And as it declines, I will make money. Now, even if it doesn't decline, the passing of time will help me make money. And that premium decay, or that time passing, there's more premium if that volatility is higher. So that is why it is number two on my list. Now, number three, supporting chart data. So this is where I will bounce the particular chart performance off of whatever trade that I'm going to take, whether it's bullish, bearish, or neutral. And so I'm going to look at the chart data and say, okay, where does the price action state that this thing is going? Does price action state that we're going higher? Does price action state that we're going lower? Does price action maybe indicate that we might be churning and consolidating and going more sideways? And that's all important because based on the volatility, that's going to push, the range that I can profit in. So the higher the volatility, the wider the range. And as long as that range somehow gets mapped to in line with the price action and the chart data, that's where I'm talking about. Like, if you get number three as a go signal, then I'm definitely going to put that on the list. Now, if the price action doesn't line up as well, I may or may not enter it. So what do I mean by that? So let's say that I've got a particular chart data that is on a downward trend, okay? And let's say that the number of the volatility number, puts my break even at like maybe 5% below its current price. Well, if I look at the chart data, and I see that the chart data might support a drop down to maybe 10% of the current price. That is where that's not going to really line up with my strike price, right? Because my break even would be at about down 5%, but there's a probability where the chart data is kind of indicating that we might go down by 10%. I might say, no thanks, I don't want to take that risk, but I might say, this is a name that I want to own, or I'd be okay owning. And because it's not really a for sure thing on the price action, if I can reconcile with myself that if we drop 10% and I get assigned and I'm okay to buy at that, 10% drop from current price, which is going to be a loss because my break even would be at around 5%, but I'm going to own something. If I can reconcile that and I'm okay with that, this is where, even though the chart data might indicate a no-go, like not in alignment, I might still proceed anyway. So that's really why number 3 is kind of an optional thing for me. It's more of a supporting data to say, how does this fare? How does this line up? But if the premium decay is good and it helps my portfolio delta, and I'm okay with where the price might end up based on the price action, I might still go ahead and proceed forward with number 3. Now, lastly, number 4, and arguably number 4 is very, very, very important, but it doesn't really factor into, am I going to make this trade, yes or no? Number 4 is more about how big do I make this trade? So number 4 is, I have decided to take a trade, but how big of a trade do I take? And position sizing is one of the most important aspects. I have several episodes specifically called position sizing in the back catalog. And the reason it's so important is because this helps you size your risk. You should never have a one particular position that consumes a large number of your portfolio. You really have to understand your risk tolerance and how much each position should take from your portfolio value. And so for me, I usually have a target range of buying power consumption that I'm looking for each trade to consume. And what I will do is I'll just change the number of contracts until I'm roughly within that range of my target buying power. And that's how I determine how big to make the trade. And the nice thing about a lot of this is you just change the number of contracts, provided you haven't picked an underlying that's way too expensive for you. I'll show you, I filter all that stuff out. So I'm not even looking at the ones that won't fit my position sizing. And really, I'm just deciding, okay, how big to make this position. All right, so let's hop over to my screener. So this screener you can replicate in whatever brokerage you have, but this is in Thinkorswim, which is the trading platform that Charles Schwab presently uses. But this similar interface will exist whatever the broker actually is. And so I have a couple of saved filters. The first one I'm going to look at is what I consider my longer term one. I call it core option char base, which basically is my core option selling things to basically look at names that might be good for option selling. This is going to be where I'm going to target things that are about a 1 month time frame for entering the trade. And so it's a really, really simple criteria here of the screener. The very first thing I do is I look at the underlying stock price. I mentioned position sizing. So this is the underlying stock price. And based on where my portfolio size is, generally I'm looking at something where the underlying is between $15 and $300. So for that range is really where premium selling will fit into my position sizing. Now, you might say, well, why don't you just go down to like $5? Why don't you go down lower than 15? Because presumably you shouldn't have a limit on your position sizing the lower you go. And the answer is pretty simple. The answer is once you get below a certain number, the premium is not really, in my opinion, worth it. And so if you're going to be below, $15, you might as well just trade straight shares. There's not much value in going the option route for the additional leverage in my the way that I trade and my opinion. So I basically cap the bottom, and honestly, I'm usually looking at the $20 and $30 as more of a minimum. I just never really kind of adjusted the screener. I let it sit down at 15. All right, so the next thing I look at is volatility index. Now, this is not the historical volatility. This is what's known as the spot volatility or the volatility percent today. So this doesn't give you an indication of where it is historically relative to itself. This just says the current value today is blah, right? Think of this like the price of gas at a gas pump. So the price of gas today is X. That doesn't tell you historically where it is relative to the range that gas has been trading in, or that you've been purchasing gas for your car in. It's just the price today is this. And so really what I have found is if your volatility is under 30%, the premium's just not worth it for me. Doesn't even matter if it's at 100% volatility. There's just not enough of it. And so I just cut these lower volatilities out and don't even consider them. So I'm really only looking for something that has spot volatility 30% or greater. Now, the next thing I'm looking at is market cap. Why do I look at market cap? Well, generally your liquidity tends to be a little bit better on the higher market cap things. So I won't say it's very high, but I'm looking at $300 million of market cap. So I'm really staying away from the stocks that are very prone to pump and dumps. The really tiny stocks, which also tend to fall below the $15 threshold. So that helps weed them out. But just the smaller companies that might have these just crazy violent swings that in my opinion, kind of outweigh the benefits of the premium selling. And so looking at market cap above 300 million is where I kind of start, and I don't put a max on it. So $1 billion, $2 billion, basically let me go all the way up through NVIDIA, Apple, Microsoft, but don't show me the little tiny companies. And then the very last one here, this is that first rough cut of not volatility, rough cut of liquidity that I was talking about. So I basically say, hey, over the past 30 days, I want at least 1 million shares traded a day. So that is an average over every 30 days. Do you trade about 1 million shares a day over a 30-day window? I have found this to be a perfectly acceptable, good rough cut. Now, if you shrink that window to shorter, you might run into some instances where like a pharmaceutical company comes out with an announcement, right? And they have this huge spike in volume for 1 or 2 days, right? And that causes like a 5-day average to go over the number. But I find if we stretch that out to a 30-day and we target about 1 million shares, it generally gives me pretty good liquid companies to start from. And so that's really where I start this whole list at. And you can see right here, I got 574 trades, potential trades that come in. So how the heck do I look through 574? It's simple. I don't. I let the cream of the crop bubble to the top. And the way that I do that is this IV percentile. I sort it in descending order, so the highest volatility, historical volatility is at the top, and I just go down the list until I find something that's interesting, and that's the first place that I'll stop. So unsorted, you can see NVIDIA's up here. NVIDIA is at about a 27% historical volatility. That is too low. I'm typically looking for 50, 60% or more because that's really where maybe I get a contraction. So Tesla is at 66%. That's somewhere that I want to consider. But the first thing I want to do is sort this thing so that the highest numbers are at the top. Now you'll notice a couple of these not applicable. I will generally skip over these. So these are basically stocks that don't have a year's worth of data. So they don't really have a historical percentage of where are they historically. So I'm going to start at maybe the 100s here, where basically this is as high a volatility as it has ever been over the last year's time. I don't like a lot of these too much because when you're at 100% volatility, I might take it if it's kind of a name that I recognize or things like that. But if I don't recognize it, I'll kind of skip over it. So when I look at this, AES, don't know, PACCAR, don't know. Discover Financial Services. That is something, that's a name I know. That's a name I recognize. When I say recognize, I basically mean it's a big company. It's been around. I might look into Discover Financial. Intel, another one I might look into. And when I do that, that's where I'm going to start pulling up the individual charts and looking into that. But I don't want to jump into the individual charts here quite yet. I want to go ahead and flip the script and say, well, let's say I'm looking for a short-term trade. Because remember, I'll take either one right now. And so what changes when I look at the short-term trade? Short-term trade, I've got a pre-filled screener for that. So I'm going to come up here. I'm going to load this thing. It's called earnings plays. So typically, if I want to take a short-term trade, it's going to be an earnings trade. And the reason it's going to be an earnings trade is because earnings typically have an announcement and then they're done on that particular Friday. And so let's see what this screener looks like. You'll find it looks very, very similar to the previous one. The first thing is, what is my close price? Here it's set to $10. I might go ahead and bump that up. I don't know why that's set there. Make it 15. Right. Volatility index, 30% or greater. These things are exactly what I had before. IV Percentile, this is when I was screening by it, but you can see 0 to 200%. The number only goes between 0 and 100, so that's really everything. So this is kind of a nonsensical value. Really where it makes a difference here is in the earnings. Has earnings in the next 8 bars. So in this case, I have my bars defined as days. So I'll lower this to 5 days because I want earnings in the next 5 days. The one below here is average volume. This is where I'm looking for 1 million shares. Now here I looked over just the past 5 days. You could extend this up to 10 if you wanted, or sorry, up to 30 to match the other value that I had. And then it's 1 million shares moving average over those to kind of weed some of but you'll see the number is pretty similar to how it matches up. Now I have another earnings thing down here. That's because if I wanted to target something like has it between a certain number, I'll kind of use this, but right now I set this the same value to the one up above. So this really has kind of no meaning. So now here are the list of names that basically have earnings within the next 5 days, which means they're in that target window of less than 5 days or about a week's trade time. And so again, I've got 44 names, so not as many. It is earnings season. Earnings season just did kick off this past week with the financials starting to report. And so I am going to look through this because earnings are a pretty fun, quick pop. And let's go ahead. And the first thing I do is bubble the things to the top. So we're going to sort in terms of IV percentile. And there is Discover Financial Services. So this is the one that I'm going to drill into today because I did not know they had earnings. But now my short-term and long-term, it has showed up on both of those triggers. And like I said, I didn't have a preference for one over the other. So we're going to dive into this name and we're going to look at a short-term trade and we're going to look at a long-term trade and kind of evaluate both of those things to see if either one really fits my portfolio and thought process. So I've gone ahead and I've pushed that over into what I call the simulator, or basically looking at the strikes to see where does this play out. What I'm going to do is here I'm going to open up the option chain and we're going to evaluate two things. So their earnings, I believe, are basically, I think it said October 16th or something like that, which is, October 16th after the bell. So that's this coming week. So we're going to go ahead and look at October 18th expiration. So the first thing I want to call out here is look at this volatility percentage over here. So the number on the far right is the actual spot volatility. And you can see the 18th has very high volatility because that's the week that earnings are in. That's the week that's going to be pumped up with extra volatility. And you can see the week after, a lot of the uncertainty is less, and they quickly drop off into the 50% spot volatility. However, historically, this is very high. So, the two trades that I would consider are the short-term trade, which would expire the week of October 18th. That's this week. A longer term would go out to a monthly. I typically look at the monthlies because they tend to be more liquid than the weeklies. So that's going to be an expiration of November 15th. So let's go ahead and look at the strikes of October 18th. So on October 18th, the first thing that I'm going to do is I'm going to probably just throw out. So whenever I do earnings, you never know if it's going to go up. You never know if it's going to go down. So I typically like to deploy earnings strangles. This goes back to that delta neutrality. Usually the first trade that I look at is a delta neutral trade. I might make an adjustment once I look at the chart, but we haven't looked at the chart yet. So let's go ahead and price out delta neutral trades. And where I'm going to start with is I'm going to look at about a 16 to 25 delta. So this column over here is the delta of the strike for that expiration. So I'm going to come down here and I'm going to look at about a 15 or 16 to 25 delta and numbers. And let's go ahead and just start with the 20 delta, which is kind of in the middle. So we'll put one of those on the put side. Then we want to be neutral. So we want to put a opposing trade on the call side. And so we're going to look here on the call side. We're going to add one of those. So one of the things I'm also looking at here is the bid and ask spread. And how wide is this to gauge volatility? Now, this is something I cannot gauge today because right now the market is actually closed. We are after hours of the market. And so this is not live data. So these are the closing prices at the close of the market that when it was last open. These are not very good representations of liquidity because they can kind of close weird. So this is something I'm going to check if I was to take this trade and put it on. I'm going to double check the liquidity before I put this trade on. And I'm probably going to look somewhere. Are we within a 5 to 25 cent spread? So right now we're above that. So this isn't quite enough liquid. Now I've traded Discover Financial Services before, and I know that these will tighten up when the market is open. So I'm going to go ahead and consider that. But that's important to note because this is where you start graining or start fine tuning that liquidity that we talked about, right? We did the rough cut to show up on the list, but this is where when you look at the list, you look at the bid ask spread to say yay, nay. And if you get a really wide bid ask spread when the market is open, exit. Don't even think about it. Exit, because you're going to be in a bad position. So anyway, what do we got here? We got collecting $3.15, so $315, and it's going to put up a buying power of about $2,000. This is pretty decent. It's definitely within my range of what I like to target. It's not quite that amazing. I would have liked just a little bit more of a ratio balance there, but for something that's a 1 week expiration, where this is going to be a bang bang done, it's possible that this might be something I keep. But let's go ahead and open up or put down here in the simulator, what if I come out to November 15th? And then we're going to look at both of these through the lens of where is the price action, where is the chart telling us. So again, going out to the 15th, I'm going to target the same thing between maybe a 16 and 25 delta. So let's go ahead and grab this one, which is a 22 delta or a 100 buck 30 strike. And then let's go down and look at your call side, and let's go ahead and take an 18. So both of these are going to be somewhere in that range. And let's see, where does this look like down here below in the premium to, so I'm going to uncheck the previous one so I get a value. Now, yes, I like this a whole lot more because here we're collecting 570 and we're consuming about the same amount of buying power. Now, the reason for this is it's a longer term trade. So it is considered a little bit less risky because there's more time for the statistics to work out. So your buying power doesn't, can kind of remain the same, yet the premium is going to be higher because there's more time to expiration. But this is very, very nice ratio to me, where you're basically risking about $2,000 to pull in about $5.70. I really like that ratio. So right now, without looking at the chart data, I'm gravitating towards the longer term trade here, where the earnings pop might be nice, but this longer term trade is pretty cool. Could even throw a combo in here, actually, now that I'm thinking about it, because 2,000, usually my position sizing I'm targeting is about 3,000. And so I might consider 2 contracts of this. It's tough because it's really that, I usually like to go 2,800 to 3,300 position sizing. So this is a little light on the position sizing, but going to 2 contracts kind of makes it a little bit heavy. But I am collecting a good credit, so it's kind of within the realm of possibility. But if I actually keep the longer term at 1, and then I go ahead and enter the short term, so I do a long and a short term. Okay, I'm at that 4,000, and I am collecting pretty good premium. So yeah, I could actually do both. But number 3. What the heck does the chart show us? And that's very, very important. So let's look over at the chart, because really the chart is kind of that last, okay, how does this line up historically? How does this really fit into things? So if we kind of hop over to the chart, there's a couple things I'm going to look at here, and I'll call them out. So I usually look at this in a 1-year daily candles. So these are your 1-year daily candles. In the past year, this is the all-time high for the year is 147.61. We're really, really at that level right there. This Christmas chart or green and red chart really shows the historical volatility. And you can see that financial services has really crept up in volatility basically since September. But the price hasn't actually moved that much, which likely means there's kind of a lot of uncertainty or stuff building in that could be up to earnings. Um, the other thing I'm going to look at is how much does this volatility contract every time there's earnings. These earnings announcements are these bubbles here, these green bubbles, green and red. And we do get a little bit of a volatility drop on earnings, but not that much actually. So it's probably not likely that we will necessarily see a big volatility contraction after earnings, which is one of the things I like on short-term trades. Really just thinking out loud here. Price action wise, we're really kind of pushing up to all-time highs. And that's usually an indication of, a ceiling. You can see we've kind of hit this one. We hit it again. We hit it again. We hit it again. It's not quite punched through. And so that's really where maybe I consider, well, how far up are the strikes that I picked above this all-time high? And I don't know if you paid attention to it, but for the short term, that call strike was about 157.50. So that's up here. And then that longer term call was actually at 170, which is even further up here. If you wanted to just say, okay, where does Discover Financial? Let's see if we just take this out to 3 years, looking at weekly candles, like we're at all-time highs for this, which is probably why the volatility has creeped up so much. Is really when you push all-time highs, there's a lot of uncertainty, a lot of potential for pullback. So I'm going to bring this back down to my normal 1 year chart here, daily candles. This is where I definitely like strangles, because you are, in my opinion, the probability of breaching a strike that is already one standard deviation above an all-time high is pretty low. And if you do, the likelihood of a pullback is also pretty good. You can kind of cushion or push that strike up by also selling the bottom side premium. So when we are pushing all-time highs, which we are, volatility is super high. That gives me very high confidence that we are safe in this probability. The probability is in our favor. The other thing that I like to look at is this very bottom RSI. Are we really close to the top of this oversold RSI indicator? And we are. 61. It's not really pushing up at that 70, but you're up there. So we are more in an overbought situation than an oversold situation. So again, that's something else where that premium plays into it. So I actually really like this trade. This chart data that I'm kind of talking through here really supports it. If this thing breaks down, what's the low side? So on the short term, it was 134, which, if we start breaking down, we likely will drop below that 134 potentially. 130 was the price of the longer term, and that I really like, that 130, because that's going to be really in this range of consolidation. So there is a high probability of support around this, which is a lot more maybe in the 125 range, so it's going to be a little bit below. But Discover Financial Services does pay a dividend. So if I end up holding these things, I'm going to be collecting a 78-cent dividend on the shares that I own. So that's always a positive. There probably is a support there. Really, this is checking all the boxes here. This really looks like a pretty safe wide trade to enter. And to be honest, taking both of these trades, looking through here, I'm actually thinking a short-term and a long-term trade. So just to kind of, if we say short-term and long-term trade, let's go back to that option view, and let's go ahead and visualize that on a longer, basically a different way to visualize it. So I'm going to put both these on here. I'm going to go ahead and put 2 expirations out, so we actually get this larger pink chart. And where this is going to show you where you fit dimensionally in a different axis. So this basically, if I take both of these trades, I'm going to risk $400 or $4,000. I'm going to basically be at about 885 collection, and my break even is really going to put me down here on the low side at 120. Now this is both trades. So let's keep these numbers in mind, and we're going to go back and look at the chart on this, and you'll see why this really is very, very comfortable in my opinion here. So on this gives me a break even to the downside of about 121 and a break even on the top side to 178. And so if we flip back to the chart, where does that put our range? So here is the chart. 178 way up here, 121 way down here, which is kind of below that support. So that is, and look at how much range we have had over the past year. I mean, this thing we're talking about, let's say, call it 120 to 180 range. So we're looking at $60 of swing. Where have you seen $60 of swing historically in the past year? That's what I mean by overstated volatility. When you get that much volatility pumped into it, the potential range becomes very, very wide. And historically, you look back at that and you just don't see that underlying moving in that range capacity. That's where the probability really tilts in your favor to say, hey, could it happen? Absolutely, it could happen. The likelihood of that happen, very, very low. So actually selling this stuff is a pretty safe thing. Of course, you have to be good with assignment, which, like I said, if you push this thing all the way up to almost 180, the chances of a retracement from there, so if you got assigned, are very, very high. And I'm okay with that. If you go really low to 120 and you breach that 120, you got a chance for support down here. If you don't, you're going to pick up dividends. Like, I'm okay with assignment on both directions. And this is a huge range to basically be trading in. So this to me is really up. Yep, I'll take both of these long-term and short-term trades. So that brings us to the end of this episode. I didn't go through another screening because I really felt I was pretty verbose on that particular underlying, and that really highlighted a lot of the thought process. I didn't actually realize I would hit a underlying that would be both good for long-term and short-term. So that was really cool because then I could kind of just talk through one of those thought processes versus trying to find a short-term trade and talking through it and a long-term trade and talking through it. Hopefully that gives you some sort of insight and perspective on the thoughts that go through my brain when I'm looking at these things. Try that. Hopefully that helps. If you guys have, questions about particular underlyings or stuff like that, join our Discord, drop a chat to myself. Drop a chat for the traders in there. Love to, I'd even do an episode if you have a particular ticker that you wanted me to talk through, say, hey, I'm looking at this. This is what I see. Be happy to kind of cover it and give you my perspective on that ticker with respect to premium selling. Like I said, that's what I engage in. This is the type of criteria that I go through. This is my thought process. I'll probably do it on a few more tickers because I've got a few different trades to deploy out there as far as capital goes. But Discover Financial Services, I really, really like for both short-term and long-term. Super good bonus that their earnings are next week. Didn't even know that. And yeah, I'm going to put an earnings trade on DFS, and then I'll go ahead and also enter a longer term trade. One of the benefits that you'll see is when you get an earnings announcement, you get a volatility contraction. Now that volatility contraction is much, 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 much higher for the week of earnings expiration, but you will get contraction on subsequent strikes. So no matter how the earnings kind of come out, there will be a volatility contraction on that longer term play. So that's kind of a nice bonus. I will expect a volatility contraction after October 16th when TFS reports its earnings. So yes, this is one that I will definitely be looking to put a trade on this week before the end of the trading day on the 16th, as that's when they report earnings. And that is the screening mechanism that I go through. So good luck out there. Hopefully you find the trading style that you do, that you like, and that you enjoy, and really just kind of hone it and perfect it and repeat it and make it a machine, make it mechanical. Figure out the objective criteria to put in there to remove all the subjectivity, remove the emotion. Trading without emotion is the only way to really trade with a clear head and make objective decisions and really properly gauge the risk. And the more that you can make that mechanical, the easier that becomes. And so you saw my criteria that I've kind of honed in over the years. It works very well for me. figure out what objective metrics work well for you and your style. And like I said, good luck out there. Have fun. And remember, think outside the block.